Okay, well, morning, guys. This is first, I guess it's a episode. All part of the masterclass that I'm gonna start filming for you guys. So this is part of the first, I say, episode of it. We're gonna start with the basic is understanding candlesticks. To some of you guys, some of you guys still don't understand what a candlestick is. As far as how the open, the close, the high, and the low, right? So every minute, whatever time frame you have, we have a candlestick. Let's say this is the 1 minute candlestick. It opens up. This is where it opens usually is, right? It could open down here. The full body, it doesn't matter. The bottom of that body is called it open. The top of the body right here, not this top, but where it closes this body here, that's where it closes. This was the high of that candle, and this is the low candle. Meaning, at some point in time, the whole candle was red, right? Like almost red. And then it picked up, highs picked up, came back up all the way to the highs, and then it came back and it closed down here, right? And this is how the body was. Same thing to do with the bearish candle. You see that this is considered, we call that the wick, right? This is also considered a wick, but this is called more of a red cell candle where it kind of sealed off, right? And then buy came back up and then closed it right here. This sold off, buy came back and closed it up there. Okay. So this is high, this is low. This is basic. Understand that. When you see a wick candle like that, meaning there's a lot of pressure down here. Buyers are stepping in to buy this candle. So wicks are strong, meaning some kind of support down here. Same thing with this. Sell was trying to sell this candle down, right? But there was support down here and it came back up, right? Even though it's red, I don't see it as a bearish candle. I see this almost like a bullish candle because I see that there's possibly some buyers coming in, adding pressure to this. But if this body was bigger body close, then yes, this would be a more pressure to downside. That means seller were in control. Were able to close strong. But this is a weak sell candle, right? Okay, let's go to different chart. Not chart, but example of candlesticks. And here we have a more of a cheat sheet, you say, about candlesticks. Okay, there we go. So you can see the fully. Here's the bearish. Uh, here's the bullish pattern, right? The hammer. Using this hammer candlestick we saw earlier. That's a bullish pattern, a single candle pattern. Inverted hammer is an inverted hammer, and then we got 3 candles reversal. That's bullish. We got dragonfly. There's a bunch of names that eventually you start hearing and understanding. But the key one to understand really are the 3 white soldiers, they call it. So when you have like 3 white soldiers like this, three green candle continuing up, that could indicate a possible or reversal to the upside, more buying power, more buying pressure coming in. And the other thing, the opposite is the 3 crow, something like that they call it. But just notice the opposite. If there's 3 continuous candle red coming down, 3 black crow they call it right here. Sorry, there we go. That's continuation to the downside, right? So those are the ones that are very common to find out. So basically, just wherever the bullish pattern was, the opposite could be true for the bearish pattern. Okay, and then other things I like to name out is like tweezer top, tweezer bottom. All it is like 2 wicks, like from the top, close and then closing strong down. It could be a tweezer top. All right, opposite is true with 2 Wicks in the bottom low. I call it tweeze the bottom. Okay. Um, and then engulfing candles. Engulfing candles are usually important too. When you see a small candle and then the next candle is engulf it way come the way bigger above it, we call it the engulfing candle. That also could present a possible um buying pressure to the upside. The same is true if you see a bearish engulfing candle where it starts off green and you got a big red candle comes in and you just engulf the whole body of that last candle. That's a bearish engulfing candle. It can tell you that, hey, whoa, there's a lot of sellers here, and it looks like they're coming in to start selling off, right? So pay attention to candlesticks in all your charts and pattern, because that could be signs of weakness in a certain trend, etc., etc. It could lead to better entry for you guys, so you can see the market better. So if you're not familiarized with candlesticks, definitely go ahead and download some candlestick pattern chart reference online. Just type in candlestick patterns. A bunch will show up, and just save it. Copy, save it, and try to memorize it. Try to learn it. And then later on, you start to see it in the chart live, and you will start to see what I'm talking about. So these are one of the basic things you need to know as far as candlesticks. Okay, and I'll pull a chart up so you saw some example of what we just talked about. Here's M and Q, and let's just try to spot some candlesticks in the 5 minute first. See, time frame makes a difference. Let's identify structure first, and then we can start to see some patterns. Right, how we see a bullish trend. Okay, great. We are in the 5 minute, 5 minute cross, and then we're going to the upside. Cool, that's great. You see that happening. You see some candlestick pattern. Here's engulfing pattern. We see some bearish pattern candles here. Right, you see 3 green candles. What it would say about 3 green candles. Right, the 3 white soldier. 1, 2, 3. Then we got an EMA cross also. So that's where you want to enter long, right? That would have been a good long there. And then you stop, maybe the candlestick below. Even if you risk 1 or 2 or 1 or 3, it doesn't matter. Obviously, this is the winner. Hindsight, this is winner. But it shows you 3 green candles, bullish trend. Okay. But we can't just go in blindly, right? Sometimes we will see that 3 green candle and then it reverses. Obviously, right? So what made this 3 green candle was a higher probability of play? But something we could consider is let's draw a trend line. Here's a 5 minute trend line to the downside, right? And then we saw market shift right here. We saw it came down, follow respect trend line, and then this is where we saw a possible double bottom reversal. So we see here rejection support, came down, a bigger wick support, and then we saw followed by a trend break with 3 green candles, followed by a EMA cross. So you have a lot of confluence that's telling you one trend break to the upside now, 3 green candle to the upside, and an EMA cross green to the upside. See this green bullish candle triangle here? That's the indicator I have on for EMA cross. That's telling you that 21 and the 9 EMA has crossed bullish. So you take an entry there. Every time you take an entry, take a stop loss right underneath the last candle or the previous candle low. Give yourself some distance just in case you get stopped out, but also recognize how much you're willing to risk. All right, and your rewards. But that's a good example. But you can't always take it blindly, right? You have to have some other confluence besides just the candlesticks. So having at least 1 or 2 confluence in your trade before you take a trade is considered A plus setup in my eyes. Okay, that meets the criteria. Okay, let's move forward. Now we're seeing markets moving up, Continue to go up. Let's say you got stop up and profit. Cool. What's next? Well, let's draw some market structure again. Now we're making new highs. Great. We could expect maybe possible continuation higher, or if it reverses, possible we can go short. Let's see what happened in the 5 minutes. So it continue to go up. Looks like it stopped here. We saw a little bit of consolidation, then a big engulfing candle. Okay, here's your first clue. We draw a trend line up, right? Now you see a big engulfing red candle. My white candle it's a red candle. Okay, that's just how I color it. But okay, that's a red candle to the downside. We saw engulfing candle. That's your sign. Okay, this is possible reversal happening. Now you can wait another candle. Okay, here goes the third candle. All right, now engulfing plus a third candle, reversal. Trend has broken, right? So you can just either wait or just take a short here. Let's say you take a short now. Sorry, that's the long. Let's say you saw that, you took a short here. And your stop is right that last candle, engulfing candle right here. That's your stop. And you're risking at least 1 or 2. Like always, I suggest 1 or 2. You made money. Okay, so that's you made some more money. Okay, on a run up, and you made money on a run down. Okay, based on what? Just market structure and trend break. Trend line break, that's one confluence. Engulfing candle to the downside, second confluence, and then what? Third candle pattern, the 3 black crow, you call it, to the downside. So those are at least 3 confluence for you to take short, and you took short, set your stop loss, and then bam, you hit profit. Cool. So it's just based on candlesticks alone, you made 2 trades in the green profit just based on candlestick alone and basic trend lines and market structure, right? You can just continue this process as long as you want. This could be your strategy that you go to if you wanted to, right? Or you can just enhance it and develop your strategy to other strategies that you can incorporate with. So this candlestick pattern base is incorporated with like trend lines and EMA. So basically, there's like three um, three strategy involved here. But in simplest term, it's pretty simple. We're looking at market structure, candlestick patterns, and using trend lines to help us navigate our trade. Okay, let's say you got that short. Market's starting to look like it's starting to chop. You got to stop out. You're just waiting now. Right here, there's really basically no trend line you can draw. It's basically consolidation chop, right? It's just basically in the box. We see that it's in the box. We see the consolidation. Finally broke out of the box here. With that being said, there is a couple of patterns coming down. EMA starting to trail down. And then it's boom, broke, right? Let's say you just missed that. You couldn't figure out when this consolidation will end. Let's say you missed this 3 candle bar down, right? Because even if you got this 3 candle bar down, it doesn't feel like you're safe. You feel like you're still in a box. Hindsight, it looks simple, but even if you got the 3 candle bar down, you're still stuck in this box, right? Let me draw this box out so it's easier to understand. Right. Changes. Do not extend. Okay. So this is the box we're in. Basically, it's consolidating. And there's a 3 candle reversal, 3 back crow, 2 downside, but still it's within this box. So you can't really, take that trade. It doesn't feel like an A+ setup. There's no trend line. There's nothing that's telling you that, hey, there's no direction I want it. This could easily reverse, right? It could easily reverse out of your favor. So you don't know what to do. But it is finally broke the box and it came down with a bigger engulfing candle. Now you say, okay, looks like it's finally ready to short, but I don't have any confidence to get in that short, right? That's fine. So you missed that short. Now you can possibly draw a trend line. All right, we got to finish the box. That's done. We can possibly draw a trend line now. Let's say you saw the reversal, it came back. Right, you have a little bit of trend line going on in 5 minutes. The price came down. You did not short it. You wait. You say, okay, if it breaks the trend line, maybe I'll look to short, or maybe if it come back, retest it, and it'll give me an entry to short instead. Right? You're not chasing the move, but you're waiting for some kind of retest in the back of your mind. There's two options you can do. Right? If I miss the move, I can either wait for a retest of that move to continue short, or I wait for this short to break, meaning a short break and reversal, and I can go long again, right? So in this case scenario, we saw that price continues to short, sell off. We saw a nice right here candle. This could present a possible doji to the upside, so a possible reversal, right? This usually is a possible. That's a strong support somewhere here. That's why we saw that this candle picked up, even though, and then it ended green. It was a positive candle, right? Candlestick. Then we got a positive body candlestick. Then we got a third kind of positive body stick, and then it continued to go up. And then this is where it hits where a trend line, where you see a possible reversal here. Also, we came back into the 21 EMA. Remember, this is a 9 EMA, 21 EMA. What I said most of the time, when you want to short something to continuation of the trend, you want to pull back right into at least a 21 EMA for you to take that entry short. And this candle right here, it doesn't feel much, but we're right at trend line. We rejected that trend line, and we're at the 21 EMA. So there's two conflicts going on right here for you to enter short. And let's say the candle ended, you saw another bearish candle, and let's say you switch back into the 1 minute chart now, okay? So you can get better look and better entry. Okay, we saw that candle, and now we say, okay, there's a bigger engulfing candle here coming in. I'm gonna enter short here in the 1 minute. Let's say you saw that engulfing candle, and I'm gonna place my stop loss at that rejection wick right above next to the trend line, and I'm gonna set mine to at least 1 or 2. Risk reward 1 or 2. Not much, but you got your 1 or 2, right? Right here. You would have probably stopped out here or here. Even if you do 1 or 3, it's still a big move. In future, that's a big move, right? So 783 all the way down to 737 around there. Yeah, 738 around there. Right, that's almost like a 50-point move. So that's a good move. Okay. And that's a 1 or 3 or 1 or 2. You already know 1 or 2 you hit. Okay, so now it continue to come lower. You can either trail candle by candle or just ride its wave. As long as it hasn't closed above the 21 EMA, you're still in the trade. Let's say if you're still in that trade for this long, that short, that's a big move you just caught, right? You didn't get stopped out. You probably get stopped out back in here where it tapped the 21, where it's probably where you stopped out, and that's still a big move. Say if you stopped out there, that's a 1 to 5 risk to reward ratio. Okay. Okay. Next example. Here we go again. It's now we saw that, stopped that, and continue to say missed on a move. What happened to the market again? Let's go back into the 5-minute higher time frame. Right. We see that it came back all the way to the trend line and a big engulfing candle after that. Right. But this is a big engulfing candle. So you're like, okay, that's a big engulfing candle. Engulfing direction. Maybe we're short again. So let's go back into the 1 minute. Let's look for entry. Okay, we saw that. We came here. We saw big, and this is considered big engulfing candle right here. Like, okay, that's big engulfing. I want to enter short, right? And this is just basic thing. You want to enter short, big engulfing candle, like I want to short, and then your last stop or last candle. One at least one or two, right? And then you get stopped out. And this is gonna happen. I see why did I do this? Because I know this is what happened. Not everything will always be perfect, and sometimes you gotta take the L. See, we saw the same thing. Can't just pick and choose just because we've seen the chart array. But let's be realistic. If we saw this happen, we saw a big engulfing candle, we're likely want to continue short again, right? But from here, it failed us because if we look back a little bit more, we saw that there is a bunch of support level here. So possible support here. So even though this is a big engulfing candle, following trend, we trace back to the EMA, all that checks, right? So we can't ignore that. So we short, and then what happened? We got stopped out, which is fine. We already made a couple good moves from our recent play, like 1, 2, 3, 4 winners, and then the last one we got stopped out. We got stopped out, and then what happened? It came back down, and it's short. It really did short after that. And sometimes that happens. You just get stopped out, and it's short, and it broke this trend, and then came back up. It found a little bit of support here, and here we got sound like possibly a double bottom, and then it came back up. Your move is right, but sometimes you get stopped out, and that's just part of trading. Don't ever beat yourself up for it. We are correct in what we did. You just got stopped out. That's all, right? So if you put a higher stop, maybe, then maybe you would have hit. Maybe that was a better choice, but higher stop. But we can't always do that. We can't always have a higher risk stop. Right? We always try to risk the least amount so that we can capture that move we want. Risk reward has to be 1 to 2. If our stop was always at that candle high, and our entry was this low here, and we're seeing support, possible support here, then really we have a really bad entry. In other words, right? That was a bad entry because we're seeing support here, right? And then we still want to short from that candle, engulfing candle. And now we're looking at, okay, our possible profit is possibly down here. Why would I want to short it? You know, you have to question yourself sometimes. But that's all hindsight. I want to show you this bad example because it's maybe something you would do one day. And then later on, you look back at it like, oh, yeah, man. Even though it looks like a good short, continuation short, that's probably a bad entry. And I'm risking getting stopped out here because I see potential support around this level, right? So something to keep in mind. That's the gist of candlesticks and trend pattern and EMA, right? That's just EMA strategy. 5 minute is the best time for me time frame as far as retracing back to 21. That's the strongest for your entry to go short. And then the lowest time frame you can go to is the 1 minute to look for entry, to snipe your entry, or the 2 minutes to snipe your entry. Those are the time frame you can look at. Just know that every time you switch a different time frame, your EMA will look different, right? Because the EMA is based on that time frame. So the 5 minute time frame, I always trust most indicator. I always say if you're using indicators, 5 minute charts seem to work out pretty well for a lot of indicators because indicators are lagging, like they're all lagging, meaning they're all behind. They are behind the price action, right? There's just an average price of each line. 9 EMA is just an average price of the fast moving EMA. 21 is just the average price of the 21 EMA, right? That's all it is. It's average, and so it's always behind. But 5 minutes seems to give the best signal on most of the indicators I tested. Once you see the 5 minute indicator, and you want to see the 5 minute indicate how it reacts to candlesticks, and then you want to drop down to a low time frame so that you can snipe the entry, right? Let's say you saw this like example, you saw this reversal coming, and then saw the saw this reversal coming, and saw this candle right here that was a possible reversal candle here. We see a big wick next into the trend line. Like, cool, let me drop into the 1 minute now, right? This is it. You drop into the 1 minute. So this is the rejection. This is the wick. All right. Now you see a nice engulfing candle, and it's followed by another engulfing candle. You hopped in short, right? Because this is, you can snipe it here, or you can snipe it a little bit lower. It depends. Like, we're not that fast or reactive sometimes, but either way, you still good, right? In 1 minute, you still good, and that's how you snipe entry. You look at things on a higher time frame, and then you come down to a lowest time frame for entry. All right, that concludes this tutorial. It's on candlesticks, EMA strategies, and trend lines.